Dear investors, in this edition, we discuss the following. First, corrective phase in the market. Second, macro data has seen some weakness. We'll talk of the results, mid-cap IT, large IT, electronic manufacturing, retailers, etc. Valuations and our belief that it continues to be time for alpha. And lastly, our portfolios which have seen some correction, how are we positioned for the future. On the first topic, correction phase in the market. Well, the year has started with a sharp correction. Now, bond yields in the US sharply climbed to over 4.8. FPIs have been strong seller in Jan after being marginal buyers in December. However, as against large caps falling relatively more in a period of strong FPI selling, in this period we have seen small caps fall more, small and mids falling more. So this has been a variation in this period. The correction could have been on profit taking after a strong rally, FPI selling on bond yield increases, and INR depreciation, which quits the pitch for hedges. End of the year consideration of retail and HNI investors, and of course margin call based selling on price drops. So this is a self-fulfilling one. Now India has been amongst the weaker markets globally in this period. However, we note that domestic investors continue to invest strongly. Domestic MFs have largely continued to match FPI selling and were also able to absorb a lot of new equity issuance related outflows in the market. Now coming to the second topic, macro, possible policy responses and impact on the market. On the economic front, while most indicators seem to be within comfortable range and inflation has fallen, there has been a continued dip in forex reserves, continued and sharp dip in forex reserves. INR has depreciated against the USD. However, happily, Israel and Hamas situation seem to be stabilizing. However, versus lower oil price expected on account of lower geopolitical risk premium, opposite happened on account of stronger US sanctions against Russian oil exports. Higher oil prices are negative for India. Moreover, if a country is unable to source cheaper Russian oil, it would result in lower margins for the refining industry. Now, happily, oil prices have receded after change of guard in the US. Well, ceteris paribus, we had expected it to be, significantly lower. So they are higher than earlier, but yeah, from the recent highs, they have receded. Bond yields in the US have also declined from their peaks, while they are still very high. We believe that US yields are very high in the context of growth of the economy, and we expect it to cool off over a period of time. We should expect FPI's flows to strengthen as our currency stabilizes and US bond yields cool off. Now, US has levied tariff on Canada and Mexico, and has threatened a 100% tariff on BRIC nations if they go forward with their plan for an alternate to USD. Illegal immigrants are being deported and citizenship by birth is being reversed. However, these measures do not impact us or our businesses in any significant manner. We wait to see if there is a duty action against us which is disproportionate to competing nations for market access, because that is something which will impact business of this nation. There are FTAs with the West which have been talked about in the media. Many of these FTAs lost momentum on changes in the regimes, we think. With new regimes in place, we expect to see renewed momentum as far as FTAs go. We think in terms of economy, our cost structures are much better versus the West, and such FTAs might work out much better for us versus FTAs for, say, the East, where cost structures are very similar. We expect markets to celebrate FTAs with West. Now coming down to result season, well, key to note is mid-cap IT, EMS and retailers have done relatively well. Quarter 3 result season has started. We believed that there has been an uptick in the economy post monsoons. We believe that quarter 2 slowdown was on account of lower government spending and higher monsoon intensity. Data is now coming in stronger for quarter 3. IIP has improved sequentially. Many retailers have shared their business update for quarter 3 and have reported strong same-store sales growth. Few banks and IT companies have also declared results. We had hoped for an improvement in these spaces. We had noted that the proposed US policy change is good for these two large spaces. Banks could see NIM stabilize, relatively speaking, as interest rate cuts have been pushed into the future. IT companies should see a more hopeful trajectory on expected better US corporate spending on corporate tax cuts. While this quarter results for IT companies have been overall on expected lines, the commentary has been hopeful. Results from mid-cap IT companies have been good. I should say select mid-cap IT companies have been good. Quick commerce companies have seen improvement in margins and are investing strongly in growth. Now, while results in some cases have been better than expected and management commentaries continue to be positive, yet the market has seen very sharp cuts in prices of many names, especially in the high growth spaces. Amongst other spaces, we believe that banks are now mature businesses with growth rates of private sector and public sector converging, and believe that valuations may reflect the new growth realities rather than be guided by the ranges of the past when growth was higher. Now, IT space continues to show a sharp divergence between large caps and select mid and small cap performance. Now, this is reflecting in valuations as investors are more convinced about the sustainability of growth of these select companies. On the next topic, valuations, and that it continues to be time for alpha. Now, this is a period of change. US has seen a precedent change. Our budget is being presented on Feb 1. Changes bring with them a period of adjustments. Portfolio which has anticipated the changes well may have a higher chance of outperformance in the coming period. Towards this, we have brought down our exposure to capex driven spaces, as we think that higher allocation in the budget versus financial 25 BE would be difficult as government has to deliver on fiscal consolidation. We expect to see lower FY25 RE in heads like irrigation, defense and railways, and on these lower numbers the budget financial 26 BE may provide a decent increase. Ordering could be strong in these spaces to use up some of the financial 25 budget which is unspent. Between now and end of the year, that is an expectation. However, clearly going forward, the focus would change from receiving more orders for the order driven businesses to executing the received orders. They already have a very high order book depending on markets and economic conditions. We have positioned our portfolio into spaces that are seeing strong tailwinds. Renewable is a global movement against climate change. With renewables come transmission infra. Defense needs have gone up considerably after Russia-Ukraine and geopolitical tensions between China and Taiwan. Indian defense products are finding more global markets. These are themes that we are focused on. Per capita income improvements are making luxury sell stronger. Consumer and financial tech companies seem to be gaining market share over brick and mortar. EMS companies are nicely positioned. Electronic imports are India's second largest imports after oil, and the need to source domestically is high. So the policy continuum should be there. It is also a space where labor absorption can be high, as it could be in garments which are smelling an opportunity on account of a turmoil in neighboring Bangladesh. Now, capital market companies are benefiting from India moving from a country of savers to a country of investors, and so on. So that gives you a drift. Our portfolio has a good representation from these spaces, while banks and IT services may see improvement versus their earlier outlook. The growth expected would be similar to or lower than the index earnings growth. these spaces are less present in our portfolios. The other spaces which are less present are commodities, which again should be headwinded on account of softer global growth. While large cap indices are trading at long period average valuations, that the spaces that our portfolios are built of are demonstrating stronger earnings growth. We believe that markets follow earnings growth corrected for valuations, and there is potential for good alpha generation from high growth segments of the market, of course, subject to market conditions and other uncertainties. We note that value style indices have started to falter after 4.5 years of strong performance from the bottom of COVID. Now, our portfolios and funds have seen a correction. Our portfolio had a relatively good September to a December calendar 24 period. However, our portfolio had a relatively weaker January. We are recording this on 23rd, so this period has been relatively weak for us. This was on account of strong selling pressure on growth stocks. Now, there are many reasons for this, and we have touched some of them in the opening paragraph itself. End of the year is a period when the mid and small cap part of the market does see heightened volatility. Almost always happens over the past 15-16 years. We have noticed that maybe this period has come a tad earlier this year. We do expect hence the volatility to remain high till end of the fiscal 2025. Now, however, given that our funds have seen performances normalize after sharp cuts in many funds, we expect to have a better chance of delivering alpha again as we go forward, although market conditions remain uncertain. Now, what have we done? We have looked into our holdings in light of the corrections and continue to believe that our portfolios are well positioned for growth, while some risk containment measures would be taken over a period of time. Now, this video will hit you on the day of the union budget. We do expect a budget where fiscal consolidation is the focus, and maybe direct tax code would be rolled out. Now, fiscal consolidation would provide greater room for RBI to cut rates, especially if forex situation improves and stabilizes. Now, the contours of the direct tax as and when they are laid out would have to be discussed. If equity related taxation reduces, it would be positive for the markets, as would be an effort to put more money in the hands of the people. Now, drop in oil prices is a positive, and any reduction in global interest rates are positive. These factors all provide tailwinds to growth investing, which is our focus. Now, while these factors are external, we believe that business growth of our investee companies should continue to be strong, and this provides the best reason for us expecting alpha in the coming period. The correction, we believe, provides a good opportunity for investors to invest. Thank you. Happy investing, and may the good times continue.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.